Hello and welcome. My name is Kathleen Lovito, and I will be your host for today's webinar on understanding long-term care. Our presenters today are Brittany Benassi of AAFMAA Wealth Management Trust and Maddie Sharpe. This webinar series is brought to you by AAFMAA Wealth Management Trust. Our mission is to be the premier provider of financial planning, investment management, and trust services to the American Armed Forces community. AAFMAA Wealth Management Trust is a fully owned subsidiary of AAFMAA. AAFMAA has proudly served America's armed forces since 1879. AAFMAA is a nonprofit tax-exempt 501c23 member-owned mutual aid association offering life insurance to all branches of the U.S. Armed Forces and their families. And finally, a few disclaimers. This presentation is educational, is for general information only, and is not specific investment, legal, or tax advice for any individual. Do not rely on this presentation alone to guide your investment management decisions. Since each situation is unique, your needs for financial services will differ. For individual advice, please contact us directly. Without further ado, let's turn it over to Brittany and Maddie to begin the presentation.
Thank you, Kathleen, and thank you for everyone for joining us today. As Kathleen mentioned, I'm joined today by Maddie Sharpe. Maddie is an independent long-term care consultant from Alexandria, Virginia, and since 2002, Maddie has been working with individuals and couples, many military given her proximity to DC, to guide them as they seek out a long-term care solution. We've hand-selected Maddie to work with our valued members because of her experience and depth of knowledge on this topic, as well as her familiarity with military and federal benefits. We know why folks don't like to talk about long-term care. It can be uncomfortable and depressing. We don't like to visualize ourselves in a situation where we become dependent on others for all of those tasks that we so often take for granted. Most of our clients mistakenly assume that TRICARE for Life or VA disability benefits will cover long-term care costs, often leading to crisis management at one of the most vulnerable phases in their retirement. But as uncomfortable as this topic may be, we at AAFMAA Wealth Management Trust would be remiss if we didn't bring this to the forefront of our members. It's part of our commitment to you, to protect you from unexpected consequences of not having a long-term care solution. Our experience tells us that talking about a problem is the first step to solving it. And when it comes to long-term care, having a solid plan early can create financial and emotional peace of mind for you and your family. You've taken a crucial step in your own long-term care planning by learning more about it today. And in this webinar, we're going to cover healthcare in America, what is long-term care, costs of care and types of coverage, benefits that don't cover long-term care, how to fund your long-term care plan, and protecting your future with a financial plan. This presentation is an overview of long-term care, but every situation is unique. At the end, we'll provide our contact information. Please feel free to reach out to us with any additional questions, and we'll be happy to help you. So let's get started. Maddie, why is the topic of long-term care such an important discussion?
Well, Brittany, Americans are living longer. The longer you live, the higher the probability that you're going to need care. Right now, 70% of Americans 65 and over will need some type of long-term care during their lifetime for an average of 3 years. Having the long-term care discussion is critical. A long-term care event is more likely to happen than not, and failing to plan for it, more often than not, results in crisis management. And by that I mean, how is your family going to handle this event? Assume your illness or disease or accident results not only in your needing care, but you're not able to be part of the solution. Your spouse and or your children have learned, as Brittany said earlier, that TRICARE and VA don't pay for long-term care services. So how will dad get the care that he needs? And if that answer isn't family caregivers, how will the bills for care be paid? Can dad's income support a caregiver expense? If assets are needed to be used, which ones and how long will they last? Now, I know that there are folks whose response to the statement is, well, I have assets, so I'll just pay for care if I ever need it. And you know, Brittany, that's a really nice statement, but it's not reality. In my experience, when the need for care comes about, no one, no matter their income and no matter their assets, want to pay $5,000 or $6,000 per month to have someone help them. It goes against every grain of their existence. So what happens? The spouse becomes the full-time caregiver, a role that's demanding, difficult, and relentless. There are a plethora of studies available online that discuss the very topic of the health effect of caring for a spouse or a parent. So while using a spouse as a caregiver is a potentially attractive alternative to formal care, the real cost comes in the negative impact on the mental and physical health of the caregiver. But sometimes maybe it's really not about the money, but about denial. Denial that you need care. Your spouse will likely play that denial game with you to spare you the truth of the reality of the situation. So the spousal caregiver solution seems to be, initially anyway, a good solution. It's cost effective, and maybe no one will notice that dad is failing, mom is covering up. And oh, by the way, it's a quick and potentially easy solution for the kids too. Mom is home all day and retired. Seems perfect, right? It's only perfect for a short time, and then things start to crumble. I've seen it happen many times. But if a plan is in place where the care is already paid for, like long-term care insurance, it's much more palatable for the spouse in need to get the care when it's needed and therefore alleviate the burden on the healthy spouse. After all, didn't mom and dad buy the policy for this very situation, to lessen the burden on that healthy spouse? Let's take a look at this slide that really tells the story. I'll admit that this slide is a bit dismal, but better to address reality when you do something about an outcome versus when it's all too late. So, how will you die? About 7% of us will be lucky enough to experience a quick and sudden death. Again, only 7%. The other 93% of us, not quite as lucky. Those deaths will take time. Terminal illness, 22%. Organ failure like heart, lungs, kidneys, about 25%. 46% of us will die slowly due to frailty. Every day, week, month that goes by, our bodies will continue to wither and will become dependent on others to assist us with those common and everyday tasks. Now, not all of those that are not within the 7% of sudden death will need long-term care. Let's look at those statistics. I like this grid because there are few words, but the picture tells the story. This first grid is the probability of your becoming hospitalized for a major operation in your old age. That's about 8% of us, 105 in 1,200. Chances are good that you'll not be a red dot. Let me just say here that although the odds are very small, no one would give up their health insurance even after looking at this grid. Now let's look at the second grid. A sea of red. The grid shows us the odds of needing long-term care as we age. That's 70% of us. 70% compared to 8% for a major hospitalization. And do you know which one is more expensive? I mean, comparing the cost of a major operation to the cost of needing care for an average of 3 years. Well, it surely depends on the type of operation, but let's suffice it to say that they are both very expensive. Why then are folks not willing to self-insure health care, but are often readily willing to insure their own long-term care? Again, we're talking a difference between 8% versus 70%.
Wow, Maddie, that's a staggering statistic. I think especially when you see it illustrated in this chart. So I think this is a great time to break down what defines long-term care and what circumstances require it. So what is long-term care? It's care you may need if you're unable to perform daily activities such as bathing, dressing, eating, personal bathroom hygiene, transferring, and continence issues. The need for care may result suddenly from accidents or sudden illness, such as heart attack or stroke. However, most often, it develops gradually as people age and certain activities become more difficult. The prevalence of cognitive disorders poses the greatest long-term care risk. And as reported by the Alzheimer's Association, people with Alzheimer's or other dementias make up a large portion of those receiving care. In assisted living facilities, over 40% have Alzheimer's or some form of dementia, and in nursing homes, 50%. Long-term care can mean help with daily activities, but it can also include services such as meals or transportation services. And of course, the goal of long-term care is to help you maintain your lifestyle as you age. Now, when we think about care, we often only think about nursing homes. However, there are several types of care depending on your needs. But in fact, most care occurs in the home. And according to a study by AARP, nearly 50% of caregiving occurs in the recipient's home. So in-home care is where most care is provided, usually by an unpaid family member or friend. In-home care is obviously a preferred option for many, and with the existence of COVID, there is now an even greater desire to continue living in your own home to receive the care and support that you need. Community care retirement communities, often referred to as CCRCs, offer different levels of service in one location, some of which are long-term care services such as assisted living and nursing home care, but many also offer independent living. These communities often require sizable upfront costs and monthly fees that can increase depending on what type of care is needed. Assisted living refers to personal care and health services provided in a residential facility, is usually an option often considered when around-the-clock care is not a requirement, but a person can no longer live independently. Nursing home care, also sometimes referred to as skilled nursing, provides a wide range of health and personal care services. Their services focus on medical care more than most assisted living facilities. Some people stay at nursing homes for a short period of time, let's say after a hospital visit, and after recovery return home. However, most nursing home residents live there permanently because they have an ongoing physical or mental condition that requires constant care and supervision. So next, I want to cover the cost of care. Now, this is a great slide. We have a map here to illustrate the cost of care in today's dollars by type of care as well as in a handful of states. What I want to illustrate here is the difference in care by type. As you can see, a big difference in in-home care versus nursing home care. And then I want to compare the cost by state. So if we take a look at the difference between Texas and Maryland, for example, you can see the difference in-home care is fairly nominal. However, there is a large difference in nursing home care, with Maryland being roughly $116,000 per year, and in Texas being roughly $58,000 per year. And just for illustrative purposes, I want to think about what the cost is in the future. So if we take today's cost in Maryland of in-home care of $54,900, and we inflate cost of care by 3% annually, the cost of care in 25 years will be roughly $115,000. So if we take Maryland again and we inflate the nursing home cost by 3% annually, in 25 years, $116,000 will grow to $244,000 per year for cost of care. So I think it's really important to think about the cost in today's dollars, but also what the cost of care will be in the future.
As someone who works exclusively with military families, as I know you do you see a lot of clients that already have a long-term care plan in place?
Yeah, that's a great question, Maddie. And as a financial planner, of course, it's great when a client already has a long-term care funding solution, but that doesn't always happen. Many of our clients mistakenly assume their government or healthcare benefits are going to cover that cost. And sometimes they find themselves in a position of needing long-term care without an established plan to pay for it. So as their financial advocate, our job is to help educate our clients on long-term care options early and often. Because over an extended period of time, it can not only potentially cause irreversible financial consequences, but also has potentially destructive impact on the entire family and caretakers. By developing a plan, we strive to help our clients mitigate the risks of a long-term care event. And I want to talk about those risks on this slide. So we know that paying for care requires reallocation of resources. And what are some of the consequences of using assets to pay for long-term care? So let's start with longevity risk, or the risk of outliving assets. And I'm going to give you an example for each of these bullets. So for example, Jack and Jane have lived well throughout their life, working until age 65 and living a very full life of traveling the country post-retirement. They've helped family financially here and there for children and grandchildren, but live within their means. And they feel that they have sufficient savings to cover a long-term care event. Unfortunately, they both have an unexpected healthcare costs. Jack has Alzheimer's, and in the interest of not burdening the children, Jane decides to move into the same community where they offer independent living so she can upgrade to a long-term care option when or if needed. They start to draw down assets to support their expenses, but have underestimated the length of care they would need and did not factor in inflation on the cost of care. They're now in advanced years, and although they're well taken care of, may soon be running out of assets to support their care. The next one is unnecessary taxes. And this is probably one of the most common consequences, and we often run into a scenario where clients begin liquidating their assets to pay for care. So I'm going to give you another example here. Mike and Molly live in Virginia, which is a non-community property state. They feel they're well prepared for a long-term care event and worked hard throughout their life to maximize savings, knowing they wanted to pass on assets to children and grandchildren. Unfortunately, Mike has experienced health issues and their children realize mom's not equipped to care for dad. Mike transitions to an assisted living facility close by. They have IRA distributions and pension income, but Molly needs that income stream to support her daily expenses. They will need to dip into their brokerage account to pay for care. For the sake of simplicity, let's assume they have an account valued at $1 million. And of that $1 million, $350,000 is gains. So if you take the difference between the values, that makes their cost basis $650,000. At the first person to pass, the surviving spouse would receive a half step up in basis. Again, for simplicity, that would mean that the surviving spouse's new basis would be $825,000. Meaning, if he or she, the survivor, need to make a sale of holdings after death, they would pay less in taxes. Taking it a step further, if both parents passed away without touching the assets, the child as a beneficiary would receive a full step up and would receive the assets with a new basis of $1 million. So that's a potentially huge tax savings there.
And that's a really good point, Brittany, because I found in my practice that folks don't realize the tax ramifications of paying for care on their own. So I hope we touch a little bit more on this later.
And we will, thank you, absolutely. I want to talk a little bit about market timing here. So if assets are needed for care in a down market, and let's play this one out. Robert and Rachel have been married 30 years and are now in their 80s. Robert recently took a bad fall and has been admitted to a nursing home. Their intention was to use some of the assets to pass to children, but now they need it for care. So they asked their financial advisor to liquidate some of their assets. Due to low interest rates, they've kept their assets productive in the market. But the market is now down 20%, but they need the funds. So this is unfortunately a bad time to liquidate assets. Liquidity, meaning are your assets available to easily sell? For example, Annie and Alex have been living in a long-term care facility for a couple of months. Their financial advisor has been working with their children who have power of attorney. They've used the majority of their assets and now need to sell the home. The home is paid off, and they need the home to continue to pay for care. The house needs to sell, but could it be hard to sell based on its location or the local market? Or what if the home that needed to sell is a rental property? Do they depend on that rental income? Lastly, shifting income to pay for care could directly impact the ability to keep financial commitments, including legacy planning for your children or grandchildren, such as college savings, family support, or special needs family support.
And that's really another great point. Clients often double count assets, the same assets that they're generating an income stream from. That's the same money that they say they're going to use to pay for their care. Well, if the assets are used for care, the income is impacted. If that income goes towards an expense or a commitment that doesn't stop just because of their ailment, then how do they continue to pay for that commitment?
Exactly. And I think that's a major consideration that needs to be thought about when making plans for long-term care funding. So moving on from financial consequences, let's talk about other risks of long-term care, which can cause irreversible damage to the caretakers. I want to talk about family member stress. Obviously, providing care can be all-consuming for family members and can have emotional and physical consequences for those who don't have a choice but to put their lives aside to care for someone else. If there's no plan or insurance in place, at least one person will have to put aside his or her life to be a caretaker. And of course, this can have a direct impact on the caretaker's well-being and family. I'll give you a great example that hits close to home for me. My father-in-law years ago came down with Pick's disease, which is a form of dementia. His diagnosis was, of course, devastating, but so too were the consequences to my mother-in-law. His condition quickly deteriorated, and over time, he needed 24/7 support. Her son, who's my husband, was in the Army, and he was unable to help with the burden. She had to make plans for alternate care for every routine outing that she did, including going to the grocery store or just getting an oil change. So as you can imagine, she didn't have time or the support to do things like visit with friends, volunteer, or even exercise. And as you can imagine, it had a tremendous impact on her health. She put her own health as second priority to his and was so stressed by the immense responsibility and lack of support. It had a huge negative impact on her. And I'll be really honest, it took her years to recover. And so this is something we've thought about, my husband and I, as we plan for our own long-term care, as this has significantly impacted our choices. And then of course, there's financial stress to caregivers. So the financial stress for caregivers can also be immense. I'll circle back to my in-laws. They were unfortunately unaware of the risk for long-term care. And when it came time, the financial burden for them was significant. Now, at this point in time, in the middle of all of this, she was now worried about her own long-term care needs and was wary of spending down the assets too fast for fear she'd also need care in the future. Of course, at this time, it's too late for her to receive long-term care insurance. And so it's very likely that my husband and I will incur those costs in the future. Many families face financial challenges when caregiving, and according to an AARP study, 1 in 5 caregivers report experiencing financial strain as a result of providing care. And it's not a surprise why, because per the same study, nearly 40% of caregivers report that they're not employed while caregiving. And these are just some examples. I'm sure there are several more. And finally, family relationships. Providing care is obviously rarely shared evenly between family, and the stress for others, when caring for others rather, rarely brings people together. Caregiving has the possibility of fracturing family relationships as there may be different expectations from different family members. And so Maddie, I know you have a personal example of this. Do you mind sharing that with us?
Absolutely. Let's talk about the impact of a blended family, because blended families are becoming more and more common today than ever. My good friend's mother, Diane, remarried later in life. She was about 75. Diane has 2 adult daughters, Carrie and Chris. Diane married Jim 5 years her senior. Jim has 2 children, Blake and Lauren. Like many, Diane nor Jim had a real long-term care plan in place. Their plan was hope that they never needed care. Jim had a stroke, left him largely immobile. Medicare paid for rehab for 17 days, and then he was on his own. Diane, 78 at the time, became full-time caregiver. Carrie and Chris, her children, quickly recognized the toll that Jim's care was taking on their mom. Carrie and Chris encouraged their mom to reach out to Jim's children to provide some of that care. Blake and Lauren did not step up to the plate. They were both working full-time jobs, and they lived a few hours away from Jim's home. It just wasn't feasible. A few months go by, and Diane's health is deteriorating. She's stressed, tired, and overwhelmed. Carrie reaches out to Jim's children for help. No return call. She calls again. No return call. Carrie and Chris then encourage Diane to put Jim in a home. Jim's pension cannot afford the cost of a care facility, and half of his assets went to wife number 1 when Jim and she divorced. If Jim went into a facility, Diane would have to subsidize the cost with her own income and savings. Ouch, says Carrie and Chris. That doesn't seem to be fair. Another call is made by Carrie to Blake and Lauren, and this time the call is answered. Blake says, "It's your mom's job to take care of her husband, not ours." Since then, Jim has passed and Diane lives with Carrie. There is no relationship now between Diane and Jim's children. This is a reality that many blended families will face when long-term care planning is neglected or hope is used as a strategy.
Wow, Maddie, thank you for sharing. I think that that's a great example. And as blended families, think about this, these complexities really should not be overlooked. And I think so often we're focused on the transition from full-time work to the freedom of retirement lifestyle that we don't think about all of the complexities of the situation and the impact. But with 70% of all 65-year-olds today needing some type of long-term care for an average of 3 years, you can't ignore this critical phase of your retirement planning. So Maddie, long-term care insurance is an effective option for people to cover the cost of long-term care. Can you tell us more about that?
Absolutely. I firmly agree that it's a solid solution for this phase in your life, but it's not for everyone. But the discussion is. Also note that too often the decision to investigate an insurance solution is too late. An insurer will not take on undue risk. And what I mean by that is that if you're already in need of care, soon will need care, or have a condition that is likely to result in your needing care, the insurer is going to reject your application. Long-term care insurance applicants are medically reviewed to be sure there are no health conditions that would disqualify them. Now, we could spend a whole session on discussing what's healthy enough. I'm confident in saying that if you're already in need of care, you will not qualify. But don't not look into this insurance because you think you're uninsurable. Get the facts. Essentially, there are 4 ways to pay for long-term care, and we're going to go through those. The first method that I'm going to talk about is what I call traditional long-term care insurance. With a traditional policy, you select the monthly amount you wish to have made available to you by the insurance company to pay for your long-term care, whether your care is at home or in a facility. You also pick how long you want the insurer to make that monthly benefit available to you. maybe 36 months, 48 months, or 60 months. Your monthly benefit will grow each year by approximately 3%, simply to try to keep up with the rising cost of long-term care. And this is absolutely critical because you may not need the care for the next 10, 20, or even 30 years. Let's move on to another method. It's called life insurance with a long-term care rider. This method allows you to use your death benefit to help pay for long-term care. The rider may or may not be offered on all life policies, but there are many carriers that do offer it. The key is that the policy typically will need to be a permanent life policy and not the more common term policies. Compared to term insurance, permanent life insurance is noticeably more costly. Why? Because the insurer knows that a payout will be due. In a term policy, fewer than 1% of term policyholders will die within the term. So this option is a good option for the following situations: the permanent life with a rider. Assume you need or want a permanent policy. Perhaps you have a disabled child, a much younger spouse, or you want your children to have ready access to cash to pay taxes on your estate. As long as you're putting a permanent policy in place, it often makes sense to add the relatively inexpensive long-term care rider. You see, the only risk that the insurer takes in offering this rider is that the death benefit may need to be paid out sooner than planned. This rider gives the policyholder the option of using the death benefit to help pay for care. I rarely see someone use this method for long-term care unless there is a need for permanent life insurance, but it is a method. The third method I'm going to talk about is called hybrid long-term care. This is a relatively new method of long-term care insurance protection. It's a long-term care policy foremost built on a life insurance chassis. It is designated to guarantee the premium for life, and it pays a death benefit approximately equal to the premiums paid in if you never have need for long-term care. The long-term care benefit is typically 3 to 4 times the premiums paid in, thereby providing you substantial leverage on your deposit. It sounds great, right? You may ask why someone would ever buy a traditional policy instead of a hybrid. Great question. And this is something I go over in detail with all clients so that we can match each situation with the appropriate solution. And finally, this is not an insurance method, but it is a method of paying for long-term care, and that's called self-funding. And we have touched on that. More often than not, it is not a planned method. It's the result of not having a plan in place. It's the result of using hope that you may never need care. And if you never do need care, or if you only need care for a few months, I'll agree that self-funding is a great way to do it. But unfortunately, there is no way to know that will not be in or will be in the 30% of the population that does not need care. Statistically, we're not going to be part of that group. Insurance provides you the leverage on your dollars, and we're going to look at that soon. But the biggest reason that self-insuring is a bad idea is that even though the money is there to self-insure, that is not the first defense when a long-term care crisis arises. As discussed earlier, the typical method is spousal care. No one wants to spend their hard-earned money on care, no matter how much they've accumulated. That's why mom is taking care of dad. They often have the money, they just don't want to spend it. When you have long-term care insurance, you've told your children that when the time comes, you want the insurer to pay for your care. You don't want your spouse to do it. You don't want your children to do it. And you don't want to deplete your assets paying for it. You bought the policy to protect your family and your assets. You know, when I'm reviewing these options with military clients, I often get the question, don't I already have coverage for this?
Thanks, Maddie. What I found folks not wanting to spend their own assets to support a long-term care event, right? So even though they may have the money to pay for it, they often don't want to spend their own money. So that's a really great question though. Yeah, as I've mentioned, most of my clients mistakenly assume that their government benefits will cover long-term care. So let's take a little time to review that in more detail on this slide. So I think it's important to clarify the types of insurance that do not cover a long-term care event. Health insurance. So this is for skilled care, which is hospital care. So if you go into a hospital, have a procedure or surgery for a medically necessary rehab, up to 100 days. Medicare is also a health insurance benefit when you turn 65, offers rehabilitative benefits on a short-term basis, and is subject to restrictions. So to be more specific, Medicare pays in full up to 20 days and co-pays for another 80. Of course, all of that's based on medical necessity. Medicaid is a federal and state program that provides care to those who meet their state's poverty guidelines. It primarily only pays for nursing home care, and you must spend down your assets to qualify. Additionally, a Medicaid facility must have a bed available. And now there are income limits. Your pension or annuity may and very likely does exceed your state's eligibility requirements.
And that's a great point, Brittany. The income limits in most states are going to be well below the military pension. So Medicaid is not a solution for most. Many think that they can give their assets away to qualify. They can't, because there is a 5-year look-back period to ensure that usable assets were not gifted.
Yep, that's absolutely right. And we often get asked about whether or not the VA administration pays for long-term care. The short answer is yes, but there are a lot of stipulations. So the Veterans Health Administration may provide coverage based on the following. 1, a service-connected disability. You must be 70% or higher with a service-connected disability. Available funding. So there must be available funding for this coverage from the federal government. To qualify for Veterans Health Administration, you'll need to go through an arduous process of qualification and acceptance. And I think it's really important to note that while you're in actual need for this type of care, you could be unable or unwilling to complete this process on your own. Lastly, depending on your circumstances, the VA may ask you to co-pay for those costs. Now, the Veterans Benefit Administration is an aid and attendance benefit, so it has similar income and asset limitations like Medicaid, and therefore is only available to those with low income or assets. And Maddie, what's your experience with the VA?
You know, I can't articulate enough just how arduous the process can be to qualify for benefits. Not only is the qualification process difficult, it can be somewhat frustrating. You couple that with one's deteriorating condition, physically or mentally, it can be a steep hill to climb. Except for those that are in financial need, I would not use VA as my fallback.
I couldn't agree with you more. And can you talk a little bit on why many people that do have the assets might choose to use long-term care insurance to fund their potential long-term care needs instead of self-funding?
I will. Here is a typical portfolio with multiple asset classes. Some folks have more slices within their pie and some less, but the idea is the same. Instead of relying on a host of these pieces to cover long-term care services, why should someone pay for insurance? Brittany, you addressed this question earlier when you pointed out that a change in health cannot be timed. It can happen when the stock market or the housing market is down. If the stock market or your real estate holdings are your long-term care plan, there are severe ramifications from selling in a down market. You also mentioned that all too often clients double count an asset. The same asset that is generating income for various lifestyles and purposes is the same asset that the clients will earmark for long-term care. And the problem with this is that a long-term care event does not necessarily negate the need for the earnings and the income that those assets create. But it's more than this. Self-insuring can be risky, inefficient, and as I said multiple times, it is a barrier to getting care when one needs care because no one wants to use their own assets to pay for it, period. They hope that TRICARE pays or Medicare pays or the VA pays, and they don't. In my 20 years of helping folks better understand the long-term care insurance offer, the question that the client vocalizes, or at least is thinking about, is this one. Maddie, long-term care insurance looks great, and it makes sense given what I've seen happen in my family or in others' families. But what if I just save the premium instead? Let me answer that question. If you never need care, saving the premium will be a stellar way to have planned for long-term care. But chances are overwhelming that you and or your spouse will need care. And if you need it for more than about 6 to 9 months, you'll not only be ahead by not self-insuring this, but it may be the key to prevent losing everything that you've worked for. Before we get to the numbers, let me ask this question. What's the bigger evil? Having insurance and never needing it, or not having insurance and needing it? If you agree that the latter is more troubling, then you'll want to learn how saving the premium is typically costly and inefficient. Now we're going to look at this slide, and I caution you to realize that on this slide, these numbers are not for you. I'm using them to make a point. These numbers are for a fictitious couple, both in their early 60s with reasonable health. You can view these numbers as a single or as a couple. There's a slash between two numbers, the first being for single, the second being for couple. So let's take a look. Let's assume that you're single for the purpose of this discussion. You invest $100,000 into long-term care insurance. That's the gray bubble all the way to the left. That's a cumulative premium that can be paid in a lump sum or over many years. On day one, you immediately have a $225,000 long-term care benefit. And that's the arrow that says number one, $225,000. You've leveraged $100,000 or considerably less if you're not playing lump sum to get a $225,000 long-term care benefit. Let's just stop right there. How could you possibly invest $100,000 today and immediately get $225,000 available to you should your health fail you tomorrow? You can't. Now look at arrow number two. We're looking 10 years out. Your long-term care benefit has grown to $300,000. And in year 20, that's the blue arrow, your long-term care benefit is $405,000 and growing. Now, maybe the question you're asking is, what if I invested the $100,000 instead? Well, if you did, and you needed care the next day, you'd have $100,000 to pay for it, not $225,000. So if you need care the next day, it's not going to work. But let's look at the next slide. Let's invest your $100,000. Brittany, if a client brings you $100,000 and tells you that they're going to set aside this money for their long-term care needs, how might you invest it? And what rate of return on an after-tax basis would you expect they'd receive? And before you answer that question, let me also say that since this is money that is more likely than not that will be needed in the future, the investment would need to be relatively safe. We don't want to take a chance of losing 20% because of a market correction.
Right. So I would say about 2 to 3%.
Well, I'm going to be a little bit more aggressive just to make my point. I agree with your number, by the way. but I'm guessing we have some folks in the audience that think we are being way too conservative. Let's use 5% after tax. That means that for someone in the 20% tax bracket, you're earning consistently about 6.25%. Well, if you invested your $100,000 today, that's the blue block, in 20 years, that's the gray block, number 2, you will have saved $265,000. Your long-term care benefit pool in the same period of time, the red block, block number 3, is worth $405,000. And again, that requires a consistent rate of return of 6.25%. And it doesn't take into account you're needing the care earlier in life. Self-funding falls apart when you need the care sooner. Are you thinking, yeah, it might be nice to have $405,000 reserved for long-term care services, but what happens if I never need care? If you don't need care, when you pass, your beneficiary will get back your premium. Now understand that this is one example of how long-term care insurance works, and these numbers are not yours. There are many other options. Perhaps you want a bigger long-term care pool of money or a smaller pool. Perhaps you're willing to forgo a death benefit. It's all possible. These high-level illustrations are not meant to give you information on which to make a decision. They're meant to encourage you to take action to look at a plan specifically designed for your situation. Now, let me turn it back to Brittany to talk about how you can request more information on long-term care planning.
Thank you, Maddie. There are plenty of reasons to delay planning for long-term care, but people who have started on this path have good things to say. They feel more in control and less worried about the future. They've made important decisions about where and how they want to live as they age, who will care for them if they need it, and how their financial resources will be used to cover the costs. Another reason to start now is that long-term care can be a little complicated, but with time on your side, you can take the process step by step and figure out what's best for you. The perfect place to start is with a financial plan developed by a certified financial planner. A financial plan helps you define all of your financial goals, including long-term care, and charts a path to help you achieve them. It's the roadmap to a secure financial future. As I mentioned, this is a brief overview and there's a lot more to cover. Every client circumstance is unique, and it can take time and attention to develop the right plan for you and your family. We'll be following up with you by email after this presentation, but if you'd like more information on long-term care or financial planning, in the meantime, we're here to help. Feel free to reach out to me using our contact information below. And special thanks to Maddie Sharpe for lending her experience to this presentation.